All right, I guess let's talk about Intel. So, I've been in this stock since 2022. My expected time frame on the whole thing playing out about 5 years, so call it 2027ish. But boy, in this red day of red days in the market, they've been especially beaten down because let's just face it, this last quarter that they just released, the financial results were pretty dismal. There's no real sugarcoating that or spinning it any other way other than those were extremely disappointing results for shareholders. They have suspended their dividend, which, by the way, they should have just suspended it entirely back when they cut it by like 75% or whatever. For whatever reason, Pat Gelsinger, even as they're saying that the dividend is suspended, they're committed to a healthy, competitive dividend in the future. Okay, great. Also, they missed on top and bottom line compared to expectations. Not something you want to see during a time when the fear index is at the max. You combine those two things and you're in for a very, very hurtful day as a shareholder. We'll go a little bit into where Intel currently stands financially and kind of figure out is it really doom? Are they done? Is this a zero? Because it's almost sort of seeming like it's priced like a zero now. Okay, so their revenue certainly has seen better days than what it's got today. This was one of the line items they missed on by a pretty good amount. And they have mentioned that in Foundry, which is what they're spending all that money building up, they have some, according to the earnings press conference, a conference call rather, they have committed business in the realm of $15 billion on Foundry, which, should that come to fruition in the next 12 to 18 months, whatever that might be, it certainly would help with this struggle on growing revenue. But at the same time, you look at where it was just a handful of years ago and where it is today, and it just looks bad on the face of it. You know what I mean? Of course, part of that could be the cyclical nature of the business, right? A lot of people did get their new laptops and setups and whatever during the pandemic. So obviously after that, there was sort of a down swing in some of their products. So it's sort of to be expected, but you combine that with these capital expenditures of $5 or $6 billion every quarter, and it's a big yikes. It's like, how are they going to sort of get by with less revenue coming in and this many capital expenditures going out? Now they do get some benefits from the CHIPS Act. That funding, they said on the earnings call, is based on certain milestones being achieved, which they say that they've been on target and hitting those milestones, and they're in close contact with the office that deals with the CHIP Act funding and everything. So according to them, everything's good with that. So that's somewhat helpful with these capital expenditures, but at the same time, it's understandable why some people might be a little skeptical on if they're really achieving what they say they are, considering how anemic the financial results have been. Okay, so another thing I want to just refresh myself on is, what is the balance sheet looking like? Obviously, I'm a fan of looking at net cash or debt, because this kind of gives you a clear picture of, okay, how levered are they? And honestly, this is a funny thing, but at $23.7 billion in net debt, they're at a similar level to a company like Starbucks in terms of the net debt that they have, which I think, when I think about what I like better going forward into the future: semiconductors, foundries, or coffee. I tend to have a better outlook over one than the other. So it's just an interesting little factoid. Now, obviously, if you still need a pretty good sized shovel on something like this, but I actually, considering the billions and billions and billions, the untold, ungodly billions of capex, I really expected this to be a lot uglier, to be honest with you. So maybe it's not quite as awful as this latest earnings report and price drop is making it seem. As a matter of fact, the tangible book value per share is at $19.51. This doesn't include any sort of goodwill or intangible assets that may also have some kind of value. But if we're only looking strictly at tangible assets, they have on the balance sheet $19.51 worth of tangible book value. So this will be a lot of your stuff like, obviously cash, inventory, property, plants, and equipment, those machines that they've bought or been buying from ASML, all of that stuff. So it seems like they've at least been getting something for all that money they've been spending. Now, granted, this is not necessarily an indication of any kind of liquidity. It would be very problematic in all likelihood for them to sell any of those assets because of how expensive they are and how few buyers there would be in the event that there's any kind of trouble where they need extra liquidity past what they're able to do through traditional means. So I don't view this necessarily as necessarily a sign of extra safety, but it does kind of, raise some eyebrows a little bit from my end on, is this kind of an overreaction price wise? And when we go over to the valuation metrics, before I really look at, the cash flow and earnings and stuff, their actual price to book value, when you factor in all of the goodwill and intangibles as well, is actually 0.84. So they're actually trading below book value. This is a little bit unusual for a tech company, to be honest. So that's interesting. Obviously, price to free cash flow, they've got negative free cash flow because of all the capex. I think everybody understands that at the moment. The price to earnings is in the 22 range, which, I mean, if you think that they're going to grow at a reasonable level, or if they had some kind of a moat, that would be pretty much in line. Okay. However, the price to operating cash flow is about 7.5. Honestly, I think since they've been indicating that there is sort of this, we're almost at the finish line, they said at one point during the conference call, on a lot of the build out and such. So I think that we can say at some point capex goes down by a lot, and therefore a lot of this operating cash flow without the capex becomes free cash flow. So unless their sales literally just completely collapse, which, some people of course are predicting out there, they would be then at a pretty cheap multiple of free cash flow at that point. But again, as they keep saying, it's coming. Some people compare it to sort of the carrot dangling on the end of the stick, keeping people chasing. But right now, sentiment is completely, almost universally negative. So that is something to think about. So these analyst targets almost certainly have not yet been fully adjusted for this earnings release that just came out. I would expect in the coming days or weeks to see a lot of downgrades on Intel, a lot of reductions in price target, etc. It'll probably go from a hold to a sell, just being real. And that's reactive, not proactive, right? They're doing it in response to something rather than seeing it coming. So it's not real. That's why I always say to take these with a grain of salt, because right now there's somebody with a high target of 66. I'm guessing we'll probably see that trimmed down, and probably a lot more in the sort of, I would guess, 15 to 20 range on the price target. Because why? Because it's down a lot and they just had a bad quarter. So that is just to be expected when something like this happens. I wouldn't hang my hat on any analyst targets for that reason, because hey, a week ago, if you looked at these, you'd say, oh, some analysts think it's going to be $60 in a year. It's probably a good buy. That's a 2x. Well, now nobody probably thinks that. So funny how the winds can change. But I do think it is kind of important to think what could be the case in the next 12 months, 18 months, 2 years with regards to what they actually are able to do, with if a lot of that capex starts to dwindle and get down to sort of a maintenance level, assuming that any of their new product lines end up as good as what they claim they are. That's the other thing. There is, of course, this idea of, at this point, what faith can we put in the guidance of Gelsinger and the management team at Intel? Because, as you know, hey, they've cut the dividend, they've announced a bunch of layoffs. And by the way, I really hope that those layoffs are in the form of either underperformers or corporate bloat, which, hey, go ahead, cut the HR department and the recruiting department down, because you don't see much need to onboard a bunch of new people at the moment with things in the way they are. Cut down on anybody that's an underperformer or whose services are no longer needed. But I would hope that they're not getting rid of anybody very talented in a very technical role that actually adds value to the business. If they're doing that, then, well, I don't see how they're going to continue to hit a lot of the targets that they say that they're going to hit with a lot of their new products that they're trying to roll out in the next year or two. So that being said, with regards to how do we get to today's price? Well, first of all, with the free cash flow, I found that even if they only got it back to 35 cents per share, which, by the way, their EPS is already at like $1.20 per share. And I think that 35 cents a share annually in free cash flow is pitifully small for Intel. So take that pitiful amount, apply your 10% discount rate, give them credit for the tangible book value. Now, this is sort of splitting the difference, because obviously a lot of their assets would be hard to turn into liquidity, but at the same time, they do have a lot of IP and stuff. Things that could be interesting for a buyer at some point. And then assume low single-digit growth in that 35 cent free cash flow. And that's how the model would get you to today's price. It's a pretty grim, like you would have to assume a lot of really grim things for today's price to be the actual price. Now, I'm not happy necessarily with the results that just came out, but at the same time, it's possible that in a time of overall general fear, in that backdrop, a bad result will result in an overcorrection rather than just a correction. I'm still sort of digesting it myself, to be honest, as a shareholder, but I try not to make any snap emotional decisions based on one major price movement. One of the things to focus on is, do we still trust the overall picture painted by Gelsinger of what they're achieving on the technology? And do we believe that when the capex goes away, that free cash flow turns back positive? Well, those are the questions I'm posing to you. Feel free to chime in the comments with your opinions on those. I encourage you to Like the video for the algorithm, subscribe for more, follow me on Twitter at Mr. Macho Mog, or X at Mr. Macho Mog, whatever you want to call it, Twitter or X, your choice. You can choose your own adventure, and please join the Discord, link in the description. We talk about stocks like Intel every single day on there. And hey, if you want to support the channel directly, be sure to consider becoming a member. Trust me, as an Intel shareholder, I really need that membership right now. Also, while I'm at it, make sure you check me out every Saturday, 8 p.m. Eastern. We do Cashflow Kings Live. That YouTube channel's link is in the description. Subscribe there, and be sure to catch us live and ask any questions you want. Take it easy, everyone.